Okay, greetings once again. We are currently now in the topic, the branches, and this topic is all about getting back to basics. So we've written some things over here. If you take a quick read, market structure, supply and demand levels, and sometimes key support and resistance levels. But do remember what we have mentioned in our previous videos where we mentioned that supply and demand can be support and resistance, but support and resistance cannot be supply and demand. Okay, the reason why we are going into this topic, it's not because it is set in stone. It is because we want to drive you back to the basics. Okay, you see that although we claim, and we mention and we believe that supply and demand is the way to trade, but in terms of price action, because we haven't gone into supply and demand just yet, we are still in the price action topic, the benchmark series. And in the benchmark series, the whole idea for all of this is to find the highest probability in order to make correct trading decisions. Okay, so since we are getting back into basics, okay, first of all, I want you guys to understand, since we previously went through the topic of indicators just complement price action, whereas price action completes indicators. Okay, so the whole idea is when you actually go to the charts, you are trying to identify first, if you look at the diagram right there, you are trying to first identify the charts and its movements. And all the charts and movements are based on the sentiment and fundamental analysis. Okay, I want to reveal something right now. Who is the sentiment and fundamental? Who drives the sentiment and who drives fundamentals? Okay, a lot of retail traders or whatever type of trader you are, many of us actually assume that the sentiment is all the market participants and fundamentals are driven by the news. Okay, this is technically it is correct. All right, the sentiment is based on all the traders, but the truth is it is all defined and manipulated by the institutions. And whereas fundamentals actually are the driving force of supply and demand. So whatever happens in fundamentals actually all drives back to supply and demand. Okay, so before you actually go through head on more, we'll talk a bit about footprints. Okay, so for simplicity's sake, I'm going to actually call technical analysis or market structure the footprint. Okay, so the whole idea is to ensure the footprint of all technical analysis is based on price action. This is for this particular case. If you cannot understand prices of a naked chart, you are not ready to trade yet. Okay, so in order for you to understand price action, you first, whether you like it or not, you first have to go through indicators. Why do you need to go through indicators? It's not because indicators work. It's because you need first, the only reason why many people discovered price action, it's because of indicators. Not many people discovered price action just because they discovered price action. First, they discovered indicators and it didn't work for them. Okay, indicators didn't work for them and they were trying to find out what is the truth. Okay, that is where they actually dropped by and discovered price action. Okay, but the truth is it all doesn't end at price action. There's actually more to it. Okay, then previously, before we went into technical analysis, we went through the roots topic and we also went into the twigs topic. And finally, we went into technical analysis. Okay, so the first and most common form of technical analysis done by new traders, okay, traders that just started trading, is in the first three topics, and mainly we actually went through indicators. And when we speak about probability, indicators are just confluences of price action. But what we are trying to identify right now is true technical analysis, which revolves all around simple lines. And for this case, just to keep it simple, we will keep it as simple and as basic as possible to just support and resistance. Okay, and previously in section 1, winter, we did talk about being there are many types of traders. There are scalpers, there are position traders, and so on. But the whole idea is to be a swing trader. And previously, we actually mentioned about what is swing trading and what there is a difference between swing trading and a swing trader. A swing trader is a trader that holds his positions from between 1 day to 1 week. This is just for an example. Okay, this is a swing trader, but swing trading is taking a trade at a better price, okay, at each swing. Okay, so basically, what are the basics? Okay, if you actually see right here in the diagram there, you have rising valleys and falling peaks. Okay, so technically, falling peaks is the start of a downtrend. Okay, we'll talk about trends a little now. And rising valleys is actually the start of an uptrend. So we'll just talk about the uptrend for now, because falling peaks is basically the opposite, the vice versa of rising valleys. So let's first start from the 3 blue circles at the bottom, okay, at the rising valleys. Okay, you have V1, V2, and V3. So these are the 3 rising valleys. Okay, so you don't look at V1 and V2. Let's just jump to V3. Okay, in V3, in most cases, an uptrend is confirmed if there are at least 3 higher lows. In certain textbooks, they will call this the 3 rising valleys. Okay, so technically, while this is technically on the chart, it looks like it works. Okay, on the chart, it looks like this is price action. This is how prices move. But to be honest, this is not how prices move. Okay, so why do I say it's technically correct? It's because in certain situations, when demand is already taken. Okay, I'll use this diagram as an example. Starting from V1. V1 is where demand was created. And V2, the second valley, is where it took the first demand, it went up. And at V3, it made an order cluster, maybe. Okay, I'll just call it an order cluster for now. So not to confuse you yet, order clusters will actually be defined in section 4 and a little in section 3. But for now, I'm just going to call it an area of high liquidity. So it creates an area of high liquidity, okay? It creates an area of high liquidity at V3, the third valley, and when prices come down at the next higher low, it collects these orders and go. Okay, apologies for the cutoff. The dogs in the neighborhood were barking again. So, okay, let's get on. Where was I just now? It creates an order cluster. This is just an assumed order cluster at the third valley, V3, and at the next higher low, that's where liquidity is taken and prices continues its up move. Okay, so technically this is how, just a quick assumption on how actually supply and demand actually works and how the orders actually work. But the problem is, if you were to actually look at all of this in terms of indicators, you will be looking at where to sell instead of where to buy, okay? So the good thing about price action is that it still puts a certain amount of probability on your side. Okay, so if you look at all the higher highs, the first higher high, most of the time a higher high is an overbought signal in the RSI where you will be stopped out. Okay, so if you are a breakout buyer, you might be stopped out too. Okay, overbought again, the next higher high, and this time it created a and it actually created an order cluster, for example, and it was barely a retracement, and overbought again. There were too many overbought signals, and if you were to be a breakout buyer, you may be stopped out quite a number of times. This is where we have actually come to the conclusion where if you actually insist on using indicators, you are to only use, as what we have previously discussed, you are to only use indicators to look for divergences. Okay? So basically, what are divergences? Divergences are when the indicator does not actually correlate or align with how prices actually move. So in this particular diagram over here, convergence is when prices are making lower lows and lower highs. Okay, lower lows, lower highs, lower lows, and lower highs. And the indicator is also making the same exact movements. But if you go further towards the end of the diagram, you can actually see a bullish divergence in which prices are still making lower lows, but the indicator is making a divergence. It's diverting away. It is not going the same direction as how prices are moving down. It is making a higher low instead of a it's making a higher low instead of a lower low. All right, so this could be an indicator where prices are going to go long, where you can actually start to buy. Okay, we don't actually recommend this. This is just for, just to put, since a lot of traders are actually still, when you actually came to this particular program, when you came to our program in MINTEDSEED, a lot of you are actually price action traders, and a lot of you are still actually using indicators. So the reason why we're actually teaching this is so that you actually still have probability on your side before we start revealing more and more truths on how prices actually move. So the same thing for bearish divergence. It's exactly the same as the bullish divergence, only that the opposite actually happens. The next one is a hidden divergence. Okay, so technically the hidden divergence is actually it actually proves that indicators don't actually work. Okay, basically what actually happens is, okay, this is for an example of a bullish divergence. Okay, so you can actually see here prices are making convergences where where higher lows and higher highs are actually being made. And the hidden bullish divergence actually happens when prices are making lower lows and lower highs, whereas the indicator continues making higher highs and higher lows. So what actually proves, why do I actually say that this particular divergence, the hidden divergence, actually proves that prices are actually superior to the indicator? I mean, currently right now you're actually looking at the indicator showing the direction. Okay, but try to imagine this. Let's just say you took away the indicator, and instead of using the indicator, you just drew a trend line and you waited for the trend line to break. I mean, why do you actually need an indicator to identify this, right? So this is why we're actually we are trying to make some comparisons over here. All right, so the next one, actually the same thing actually happens for the hidden bearish divergence, and you can actually look for convergences and divergences with moving averages. Okay, so technically the MACD indicator, we have talked about this. I cannot actually remember the exact numbers of the MACD indicator. Well, who cares? If I'm not mistaken, it's the number 9 and number 26 or 21, I can't remember, for moving averages. Well, who cares about that, because it's not actually important. You actually don't have to use it as an indicator located at the bottom of your chart. You can actually plot it out as moving averages on your chart. Okay, So anyways, this is how we have actually discussed this already, uh, where you have buy and sell signals. Okay, a lot of if you go online and you do your research about how to use indicators, many things you'll actually find online actually teaches you to use the MACD indicator as this particular example over here, which is actually not recommended. So since the moving average convergence and divergence indicator, the MACD indicator talks about convergence and divergence, you are actually supposed to use it like this. Okay, so you can actually see the bullish divergence where prices are actually making lower lows, but it is diverting, the indicator is diverting away, and instead of making lower lows, it's actually making a higher low. And if you look at the bullish convergence shows prices making higher highs, and the indicator itself is also making higher highs. Okay, so this actually puts more probability, and you will not actually run into false signals. You won't actually run into random signals telling you where to buy and sell. Okay, so if you're going to incorporate these concepts into your trading strategy or trading method, this is the only way you should be actually using indicators. And any other way, okay, I'll put it simple. We do not actually recommend the use of any indicator, but if you are going to use an indicator, use it as a measurement for probability. Okay, worst come to the worst, although we do not believe that trends actually exist, although it looks like it exists on the charts, just to put probability on your side, okay, you can use convergences. And if you want to look for reversals, just to put probability on your side, you can actually look at divergences. So we have come to the end of the topic. And the first thing that I actually want to mention is, first of all, keep things simple for now and get back to the basics, and do try to understand how prices actually move. Okay, so currently we have gone through structure, we have gone through roots, trunk, and this topic, branches, where the conclusion is try to use less or no indicators. Okay, because if you actually look around, there are a lot of fancy looking indicators, and everyone is claiming that they combine, they actually found the magic moving average number or whatever. And to be honest, there is actually no such thing. Okay, and the problem is, the ultimate scam is the price action strategy. Okay, there is no such strategy. Okay, price action is not a strategy. It is a way, it is a method of actually, it's a way and method of reading price. Okay, you are just reading prices. Okay, so even if we want to characterize it as a strategy, we rather call it actually an understanding instead. Okay, and this will bring us to our next topic, where we want to actually go on further to actually explain a different form of indicator. Okay, and this different form of indicator, okay, although it's categorized as an indicator, it is not actually an indicator. It is actually a method of identifying certain elements known as structure. Not structure, you can consider it structure, but it is a method of understanding sessions, cycles, fractals, how much money is actually placed into the market, and how much money actually goes for profit or manipulation, and so on. However, we won't be going into too much of it for this one, but we'll keep it simple and boil it down to ratios and fractals. So this will be in the next video, and it will be about the golden ratio, or we can actually call it Fibonacci ratios. Okay, Fibonacci. So we'll see you in the next one with this topic. Okay, so we'll see you in the next one with this topic.